Y'all have been blowing up my inbox and my DMs asking about what to do now that the stock market is dropping. And so I actually have a lesson in our 10X investing course that I'm going to pull out. I'm going to give it to you. Watch it. This is not financial advice. I'm not your financial advisor. I'm not telling you what to do, but I am telling you what I'm doing and how I think about these things and how I am working through this. So enjoy. So in this lesson, I want to help those of you who are freaking out because you're seeing your investments drop because the market has gone backwards. This might be right now when I'm recording this, or this might have been 3 months ago. This might have been a year ago. This might have been any number of times in the past or in the future because it has happened a bunch. It's going to continue to happen a bunch, which is kind of the first point of this whole thing. But I want to take you over and show you a couple different charts that might help ease your nerves a little bit. And then ask a few questions to kind of help you navigate through all of this. So the first one is this chart right here that shows the market corrections we've had since 2009. So starting in about 2009, we went up and then we dropped about 15% for a short little window. And then we went up again. Then we dropped about 18%. Then we went up again for a long time for about 3 or 4 years. Then we dropped about 12%, went up a little bit, dropped another 13%, just kind of bounced back down. Then we had a good couple years all the way up into 2018, dropped about 10%. And then we went over here to about 2020, dropped about 19%. And so this pattern just continues. But if you look at this chart as a whole, you'll notice a trend. It's going upwards. And if you're looking at any chart just over a short-term period, so maybe even this entire year, you just see everything's going down, or especially if you're looking at by the week or the month, like when things are kind of going crazy, it just looks like straight down. But that's why there's this common phrase in investing where they say, when in doubt, zoom out, because you want to be able to see the longer-term perspective of how things are going. And so in terms of investing in the S&P 500 over the last, 13, 14 years this has been, it's looked really good. And so you've definitely had some times of hiccup, but it's just important to remember that the upward trajectory seems to be in play still over the long term. All right, now here is another chart that I think is really, really telling. And this one goes all the way back to 1949. And so this one breaks it out by the average bull run when the market was on its way up and strong and doing well versus the bear markets when the market is going backwards, where it's retracting and where you're losing money. Okay, and so this is such a powerful illustration because, again, you see here for all the way from 1949, like how much it went up and then just a little bit it goes down. And much it goes up, a little bit it goes down. And so you see this pattern playing over and over and over again for 80 years or so at this point. And this is great, seeing the average bull market has about a 263% return over 71 months. The average bear market has about a negative 33% return over 14 months. And so, again, when you can zoom out, see the big picture of how this works over the long term, it can really be encouraging, and it can help you see that when you are in one of these cycles where things are down, that it's not going to be like this forever. This is a temporary thing. And I'm saying that with confidence, even though we don't know for sure, there's no guarantees when it comes to any investing. There's no guarantee that the S&P 500 is going to continue to do well and that this pattern might not change. But again, we have 80 years of history to kind of look back at this pattern. And so it helps us draw some conclusions about what might happen in the future. All right, now I want to look at one more chart here because this one is also really powerful, and it looks at all of the market declines where it was more than 15%. So these would be recessions that we had or depressions that we've had, big market pullbacks. And what this chart is showing is it's showing on the light color how much the market dropped. And so you can see these little percentages over here. And so down in the Great Depression, probably 80% drop, huge drop. And then some of these other corrections are smaller, somewhere in the 15, 20% range, some as big as 50%. But what's powerful here is looking at the dark blue lines, because this is what happened the 12 months after we had the recession or after we had the market pullback. And this is really, really interesting because in all of these situations, you see that the market came back strong after that thing. And so that's really powerful. So the average 12-month return after a steep market decline is 55%. And so what I take from this is when we're going through a tough time in the market, when things are going backwards, when it feels like we're losing money, around the corner, the odds are that we're going to have a pretty big boom in the market, and the average 12-month return is 55%. So that's exciting when you can think about it that way, that yes, things are tight right now. Things are not going the way that we want. But if you can look back at what's happened in the past, draw some conclusions about what might be happening in the future after this thing ends, it kind of gets exciting. So now the context of all three of these different charts is someone invested in the S&P 500 index, okay? And so this is why this is so much of what we're talking about in the first part of the 10X investing course, because this is the foundation. And so if you happen to own an individual stock, you might notice a similar pattern to what's going on here, because almost all stocks are subject to the ebbs and flows of the market. Now, that doesn't mean that the market is going to determine exactly what that stock is going to do, but it normally affects it to some extent. And so that pattern might be present there, but at the same time, like, you have much higher level of risk because anything could happen with that company. So for example, Enron, it could be just a big crook running the company and you could lose everything, or it could just be a bad business model and you could lose everything. So it's important to remember that if you are just owning a single stock, like, you're not very diversified and you're missing out on some of the safety you could have by diversifying a little bit more. And so if you're in a situation where you're freaking out right now, it'd be a good question to ask yourself, am I diversified enough? Because that diversification is going to be the thing that's going to provide some sort of hedge of safety. And if the answer is no, you feel like you're not diversified enough because you only own 3 stocks and you don't own an index fund, then yeah, going back and looking at the S&P 500 index fund, looking at some of the other investing strategies that we talked about earlier in this course might be something to consider. So now that all of that is out of the way, I want to talk a little bit about what I am doing currently as we're in a bear market, as we've seen the market contract a lot. I've seen a lot of my numbers in my accounts go way down, but I've been through this enough. I've read enough from other really experienced investors. I've experienced it myself multiple times now that I want to buy more because I know that things are on sale. It's cheaper now. And so just like when I go to the grocery store and I see my favorite ice cream is 30% off, it's like, all right, I kind of want to stock up because I know next week it's going to be regular price again. And that's how I'm viewing this market. That's how I'm viewing what's going on. I fully expect in a couple of years from now, everything to go back up in price. And right now I can buy it at a discount. So I'm actively looking to see how I can get more money into the market right now. And yes, I don't know if we're at the bottom. So I might put money in it. It might go down a little bit more. But again, I view this as a sale. I view this as an opportunity. And really, that's what you want to be thinking of as an investor. How can I buy in at times when things are on sale rather than buying in when everyone thinks everything's going to go up forever and at those high points of the market? And one final point I will leave you with is that you and I have the opportunity to put our trust in God and not in our investments and not in how much we've saved up. Ultimately, at the end of the day, we can come back to Philippians 4:19, where it says, "My God shall supply all of your need according to his riches and glory by Christ Jesus." We understand that it's God's role, his position, his desire, his responsibility to take care and provide for us, and that it isn't dependent on us and our ability to invest well for the future. That is really empowering. That is really encouraging. That brings peace to my heart when I'm in moments where I'm freaking out and when I'm nervous. So I would encourage you to lean into that as well if you're having one of these moments where you feel like, I don't know what to do and I'm so nervous and fearful about the future. At the end of the day, God is our provider and he is going to take care of us.